If you're self-employed and running your own business, you're likely operating as a sole trader, also known as a sole proprietorship. Understanding how much tax you will pay as a sole trader is crucial for the success of your small business. Being a sole trader is the simplest business structure, but it comes with its own set of tax responsibilities. As a sole trader, you'll pay income tax on your business profits after deducting allowable expenses. The tax rates start at 0 and go up to 45% depending on your income. For income up to the tax-free personal allowance, you pay no tax. Income over the personal allowance will then enter the basic rate tax band, which imposes a 20% tax rate. Income over the basic rate band then enters the higher rate bracket, which charges tax at 40% on all income within that tax band. Any taxable income over the higher rate band is taxed at the additional rate of tax, which is set at 45% on all income within that tax bracket. In addition to income tax, sole traders are responsible for national insurance contributions. You will normally have to pay Class 4 national insurance contributions, which is set at 2%, and you can choose to pay Class 2 national insurance in some specific circumstances. Being a sole trader has several advantages. The registration process is straightforward, and you have more privacy compared to limited companies. You have complete ownership and control over your business decisions, and there's flexibility to change your business structure in the future, if needed. There's also less paperwork and lower setup costs compared to other business structures. However, there are some drawbacks to consider. As a sole trader, you have unlimited liability for business debts, which means your personal assets could be at risk. You may have fewer tax efficiency options compared to limited companies, and some organisations and lenders may prefer to work with limited companies over sole traders. As a sole trader, you're required to complete an annual self-assessment tax return. This is where you report your income, expenses, and any other income to HMRC. You'll need to pay your tax bill by the 31st of January, following the relevant tax year. It's important to be aware of HMRC's Making Tax Digital for Income Tax Self-Assessment. This will require sole traders to keep digital records and report to HMRC quarterly. The implementation date depends on your income level, with higher earners required to comply earlier. To register as a sole trader, you need to complete a CWF1 form and set up a self-assessment record with HMRC. You can register as a sole trader online at www.gov.uk, register for self-assessment. You must register for VAT if your taxable turnover meets the threshold, but you can also register voluntarily if it would benefit your business. Finally, consider working with a sole trader accountant. They can help with bookkeeping, producing accounts, submitting tax returns, and providing valuable advice on tax planning and compliance. Their expertise can be invaluable in navigating the complexities of sole trader taxes and keeping your business financially healthy. You can find out more about tax rebates and tax calculators at www.taxrebateservices.co.uk. The content used in this video is intended for educational and informational purposes only and does not constitute advice. We recommend that you do your own research on each subject and take advice from HMRC or a professional tax advisor.